21.1 GDP, Income and Expenditure. In this chapter, we study meaning of GDP, circular flow in the US economy, the circular flow and equality of income and expenditure. To know where the US economy is heading, will it remain weak, to expand more rapidly, or sink into a deeper recession? In simple words, to access the health or state of an economy, we measure gross domestic product or GDP. In this chapter, we study how GDP measures the value of total production, total income, and total expenditure. GDP defined. We measure total production as gross domestic product or GDP, which is the market value of all the final goods and services produced within a country in a given time period. This definition has four parts. Value produced. To measure total production, GDP, instead of measuring the physical quantity of goods and services produced, like 100 apples, 50 oranges, etc., it measures the market value of the total production or at the prices at which the items are traded in the market. If the price of an apple is 10 cents and the price of an orange is 20 cents, the market value of 100 apples, that is 10 cents times 100 apples is equal to $10, and market value of 50 oranges is 20 cents times 50 oranges is equal to $10. So the market value of 100 apples and 50 oranges is $20. What produced? GDP measures the market value of all final goods and services produced in an economy in a given period of time and not the intermediate good or services. A final good is a finished product produced for its final user, whereas intermediate goods and services are used as a component of final goods or services. For example, a Ford car is a final good, but a Firestone tire that Ford buys and installs on the car is an intermediate good. In contrast, if you buy a replacement Firestone tire for your car, then the tire is a final good. The same good can be either final or intermediate depending on how it is used. It includes only those items that are traded in markets and does not include the value of goods and services that people produce for their own use. For example, if you buy a car wash, the value produced is included in GDP. But you wash your own car, your production is not counted as part of GDP. The exception is the market value of homes that people own. GDP puts a rental value on these homes and pretends that a owner rent their homes to themselves. Where produced. Only goods and services that produced within a country, geographical boundary of a country, count as part of that country's GDP. Nike Corporation, a US firm, produces sneakers in Vietnam, and the market value of those shoes is part of Vietnam's GDP, not part of US GDP. Toyota, a Japanese company, produces automobiles in Georgetown, Kentucky. The value of this production is part of US GDP, not part of Japan's GDP. When produced, GDP measures the value of production during a given time period. This time period is either a quarter a year, called the quarterly GDP data, or a year, called the annual GDP data. The Federal Reserve and others use the quarterly GDP data to keep track of the short-term evolution of the economy, and economists use the annual GDP data to examine long-term trends. Circular flow in the US economy. Four groups buy the final goods and services produced: households, firms, garments, and the rest of the world. Four types of expenditure corresponds to these groups. Consumption expenditure, investment expenditure, garment expenditure on goods and services, net exports of goods and services. Consumption expenditure. Consumption expenditure is the expenditure by households on consumption of goods and services. It includes expenditure on non-durable goods such as orange juice and pizza, durable goods such as televisions and DVD players, and services such as rock concerts and haircuts. Consumption expenditure is also includes house and apartment rents, including the rental value of owner-occupied housing. Investment expenditure. Investment is the purchase of new capital goods, that is tools, instruments, machines and buildings, and additions to inventories. Capital goods are durable goods produced by one firm and brought by another. Examples are personal computers produced by Dell and brought by Ford Motor Company, and aeroplanes produced by Boeing and brought by United Airlines. Investment also includes the purchase of new homes by households. At the end of a year, some of the firm's output might remain unsold. For example, if Ford purchases 4 million cars and sells 3.9 million of them, the other 0.1 million, that is 100,000 cars, remain unsold. In this case, Ford's inventory of cars increases by 100,000. When a firm adds unsold output to inventory, we count those items as part of investment. It is important to note that investment does not include the purchase of stocks and bonds. In macroeconomics, we reserve the term investment for the purchase of new capital goods and the addition of inventories. Government expenditure on goods and services. Government expenditure on goods and services is expenditure by all levels of government on goods and services. For example, the US Defense Department buys missiles and other weapon systems. The State Department buys travel services. The White House buys internet services, and the state and local governments buys cruisers for law enforcement officers. Net exports of goods and services. It is the value of exports of goods and services minus the value of imports in goods and services. Exports of goods and services items that firms in the United States purchase and sell to the rest of the world. Imports of the goods and services items that households, firms, and governments in the United States buy from the rest of the world. If export exceeds imports, net exports are positive and expenditure on US produced goods and services increases. If import exceeds exports, net exports are negative and expenditure on US produced goods and services decreases. Total expenditure. Total expenditure on goods and services produced in the United States is the sum of the four items we just discussed. We call consumption expenditure C, investment I, government expenditure on goods and services G, and net exports of goods and services NX. So total expenditure, which is also the total amount received by the producers of final goods and services, is total expenditure equals C plus I plus G plus NX. Income. Labor earns wages, capital earns interest, land earns rent, and entrepreneurship earns profit. Household receives incomes. Some part of total income called undistributed profit is a combination of interest and profit that firms retain and do not pay to households. But from an economic viewpoint, undistributed profit is income paid to households and then loaned to firms. This is the picture or the figure of circular flow of income and expenditure of the US economy. Now we shall see how the circular flow expenditure equals income. Figure shows the circular flow of income and expenditure that we have just described. We call total income Y is shown by the blue flow from firms to households in the form of rent, wages, and interest. The green flow from households to government labeled NT and from households to financial markets labeled S. These two green flows are not expenditure on goods and services. They are just flows of money. Because households allocate all their incomes after paying net taxes to consumption and saving. Y is the income equals consumption plus saving plus net taxes. Net taxes equals taxes paid minus cash benefits received from government, and savings is the amount of income that is not paid in net taxes or spent on consumption of goods and services. Savings flows from households to financial markets and is in the green flow labeled S. The red flow in the figure shows the four expenditure flows. Consumption expenditure from households to firms C, government expenditure from government to firms G, net exports from the rest of the world to firms NX. Investment flows from the financial markets where firms borrow by to buy capital goods I from other firms. Because firms pay out everything they receive as incomes to the factors of production, total expenditure equals total income, that is Y is equal to C plus I plus G plus NX. From the viewpoint of firms, the value of production is the cost of production, which equals income. From the viewpoint of purchasers or the consumers of goods and services, the value of production is the cost of buying it, which equals expenditure. So the value of production equals income equals expenditure.